Hi everyone, welcome to our financial management class. Today we are going to study about security analysis. Okay, now security analysis basically is talking about analyzing before purchasing a share or a security. Okay, to analyze before we purchase a share or a security. Now, what do I have to analyze? If I want to do an investment, we have already been talking about it a lot. Okay, when I want to do an investment in the market, obviously there is a risk associated to it. Okay, there is a risk associated to it. Also, there is a huge amount of investment. Okay, it can be for your intraday purpose, you just want to make money for one day and come out of it, or it is for your long term relationship you want to maintain with that company. It can be anything. Okay, so for that you have to analyze a security. Even the portfolio managers, before investing our money in any kind of securities, they analyze it with accordance to a lot of theories and fundamentals and technicality of a security which is there in that particular, that for that company, or say in that industry, or which are the best shares across, or which are listed on the market. All this is being taken into consideration. Okay, that is what is the security analysis actually talking about. So basically the decision of the investor, as an investor, if you want to think as an investor, you have to understand many issues. What are those issues? Asset class to invest, which shares, bonds, bullion, etc. Okay, the horizon, how much combination should be there in risk free securities or risk related securities, how can you diversify your risk, okay, and earn maximum returns, is what we talk about securities. Now, what are securities? We already know it has been defined under Section 2 Subsection Act, or Securities Contract Regulation Act 1956. It obviously includes shares, scrips, bonds, debentures, stock, okay, mutual funds, units in your AIF, Alternative Investment Fund, okay, your CIS, any other securities as declared by the central government. Okay. Now, investment and speculation are two different things. If you are disciplined in your investment purpose, okay, you are investing in order to have a relationship with that organization, in order to earn returns, in order to grow with that organization, is your investment. But speculation is something which you are doing based on what is being, just like you can say one time information or some kind of a rumor, because of which there is a sudden spike or sudden fall in that particular, share or that price, okay, of that particular company. So there is a distinguish between speculation, when you do speculation, and when you do investment. What is investment? Basically, you purchase an asset with the hope of getting returns, is called as investment. And speculation is just for the purpose of making profit. Okay, so you know that today particular share price is going to be rupees 100 and it is going to increase. There is a speculation in the market, it is going to close at 120. You will just enter in today, you will come out tomorrow. Okay, you have earned 20 rupees. So say like that, if you have 100 shares also, you have earned 2000. You have earned 2000 rupees. Basis of the decision, when you invest, you see the fundamental factors, you see the performance of the company. Here you see the charts and you just follow the market psychology. Market is going up, so even my share price is going to go up. Time horizon, long term, of course, investment. Short term is for speculation. Risk which is involved, moderate, because over the period, where you have invested, obviously your risk is going to be less only. You have invested your money today and today you will not remove it, correct? Then you have high risk in speculation. Intent to profit, changes in the value. Here there is changes in the price, you are more interested in the value change. Expected rate of return, there will be moderate, here it will be obviously high rate of return. Funds, investor uses his own funds. Here borrowed funds are used for speculation purpose. Income is stable. This is something which is uncertain. You really don't know whether it is going to be an income or no. And behavior of the participants, it is conservative, they are cautious, they are disciplined, and here they are careless. Okay, so there is a difference between investment and speculation. Similarly, there is a difference between investment and gambling. Okay, betting, both gambling and betting are the games of chance, whether you will get return or whether of an event which will happen, which may not happen. Okay, generally we do this in case of derivative trade, futures, options, swap, all that are all kind of a betting. Okay, it's like a gambling. Same thing, investment is for a long planning horizon, gambling is for short planning. Then there is scientific analysis of the intrinsic value of that security. We have all studied about intrinsic value, your yield value, okay, fair value of the security. So investors here make the decision based on that. This is based on the tips and rumors. Okay, in between even I had got a tip that there was a stock which was Godrej Agro. Okay, so there was a tip about this particular company, so I had invested in this stock. Okay, good amount of stock I had bought, and the very next day, like I think so on that day or in very next day or in 1 week, my profit was showing only 5,000, only the profit. Okay, 5,000, because I had invested small amount, because I knew I'm not going to keep it for long term. Now it is depending on me whether I want to exit with that profit or I want to keep. I had not gone through the fundamentals of this particular company. I had just done this activity based on one rumor. However, I did not book the profit, and today I am standing with the same amount of loss. Okay. If I would have done it for an investment purpose, I would have done it as a planned decision, looking at the fundamentals. I may have not invested. And even if I would have invested, I would have treated as a gambling and removed the money. Okay, that is the difference. Risk, there is of course commercial risk. This is an artificial risk which is involved. Risk return trade-off determines the return, risk return, and here you have negative returns are expected. Yes, I am standing at negative 5,000 today, as on today. Motives, safety of principal and stability of returns, entertainment while earning, you are enjoying. Okay, similarly my one friend also had done the same thing. Though his profit was 50,000, he booked it, he came out, he enjoyed it. Okay, so there is a difference in investment and gambling as well. Now security analysis, first we see the fundamental analysis are what is all your balance sheet, the ratio analysis which we had done in our accounts, ratio analysis. Then we did intrinsic value, finding the value, fair value, intrinsic value, yield value, based on the balance sheet of the organization, the fundamentals of the organization, how much is their price earning ratio, how much is their earning per share. Okay, the analysis which is done by Warren Buffett before he does any investment in any security. And next is the technical analysis, which is based on charts, daily chart. Okay, how it is moving, the moving trend, up, down. Okay, what is the amount, what is the price of the opening price of the security, the closing price of the security on daily basis. Then you can see those chart weekly, monthly, yearly, to understand the trend of that security in the market. Okay, now fundamental analysis, it is 3 level. Basically you analyze the entire economy, then from that economy you analyze the industry in which you are going to invest and where your shares are, and then company analysis. Okay, so if I am the one who invests in, say, only top class securities, okay, top class monopoly securities, top class. Okay, so first I know, okay, like top class securities, you can say that if you want to invest in an industry which is into say like best in adhesive manufacturing. Okay, so we all know Fevicol. Then into paints, Asian Paints. Okay, bank, HDFC Bank. Okay, all top class securities, looking at the economy, analyzing the industry, and then coming to the company analysis. Okay, so from top to bottom, this is the analysis which is done on the fundamental basis. Okay, Next is your technical analysis. Technical analysis are all about the charts. Okay, it shows you the share prices which are moving on real time basis. Okay, on the real time basis. If in case you all have your Zerodha account also, like how I have, in that if I click on a particular stock and I go on to charts, view charts, I can come to know that okay, this particular stock opened at 100 rupees today. Now it is being traded at 120. It had also fallen to 100 back. Now still it is sustaining and now again gone back to 120. I can see the trend based on that chart. So technical analysis is nothing but the charts. Okay. So here, if you see in fundamental analysis, share prices are predicted basis of the 3-stage analysis, which was economy, then your industry, and then you look after the company. You study it like this, okay, before investing. So that is your fundamental analysis. Okay, now after you have completed your fundamental analysis, the deciding factors that emerge are the financial performance indicators like earning, dividend of the company. All that also you see now, it is easily available. Okay, the app on which I trade, Zerodha, the moment I click on fundamentals of that security, I come to know everything. How much is their rate of return? What is their price earning ratio? What is the price earning ratio of the entire sector? How much is the company giving price earning ratio? Everything is there. Whether should a buyer invest or no, even that is given. Okay, so all that is easily now available online. The fundamentalist makes a judgment of the equity share value with the risk return framework based upon the earning power and the economic environment. However, in the actual practice, it often happens that a share having sound fundamental refuses to rise in the value and vice versa. Okay, so there are certain companies which are bad with fundamentals, still people are buying. Still, okay, for example, Adani. There are certain companies, if you will see their fundamentals, like Canara Bank, okay, which was even analyzed by Rakesh Junjunwala. But if you will see, nobody is buying. It has got fantastic fundamentals. So even fundamental analysis sometimes fail. Okay, it is not only method of analyzing and buying a security. So we would now examine all the alternative approaches for this particular share price behavior. Okay, so for that we need technical analysis. Now, in technical analysis, there is this theory which is given by Dow Jones. Okay, the theory was formulated by Charles H. Dow, okay, of Dow Jones and Company, who was the first editor of Wall Street Journal, USA. Now, what did he give? Simple. Based on this graph, what do you understand? This is the time. Okay, so say day 1, this is the time today, and the price. So I was just having a look at the price of Navneet shares. Navneet. Okay, so the trend, it will show a bullish trend. Bullish means the price has started from low, rising. It has fallen a little down, but again it is rising. So it is having higher highs and lower lows. See, higher highs, the high is going higher and higher, low is lower lows. Then it has touched its peak and now it is coming and falling down. This is known, this year particularly is known as a bullish trend. Similarly, if I will do the opposite of it, it will be known as a bearish trend, where it has started with a peak, with a high price. Now it is falling. Again it rised, but now again it is falling. So there are higher lows and lower highs. See, though from after falling it is rising, but it is a lower high and higher lows. Okay, so this is known as a bearish trend. This is the basic, simple bullish and bearish trend. Okay, now there are certain secondary trends also which an analyst can look at, okay, when they are looking at the charts. Here in Dow theory, a primary trend is the main direction. So if I am telling you that the price is going higher and high, you will tell me that ma'am it is a bullish trend, or if it is falling you will tell me it is a bearish trend. That is the primary trend which is given by Dow Jones. Okay, now The secondary trend moves in the opposite direction of the primary trend. Okay, where there is a reversal of the trend. So while it was rising, it started reversing. Okay, it started reversing. It is known as the secondary trend. Secondary trend. Okay, this reversal. So there can be a, why is the reversal? It is correcting the primary trend now. Okay, so say for example, an upward trend will be composed of secondary downward trends also. The movement from a consecutively higher high, it will go to a consecutively lower high. Now, in a primary downward trend, the secondary trend will be an upward move. Obviously, it will be an upward move or a rally. If the primary was a downward, secondary will be an upward, like how you have it in this graph. Okay, it touched the bottom peak and now it is rising. Now it is rising. Now it is having higher highs and lower lows. Okay, so secondary trends are just opposite of the primary trend. That's all you'll have to remember. Next is your minor trends. Minor trends are those which where you look at the charts for less than 3 weeks time. Okay, so you're looking at the daily chart, or you're looking at 1 week or 1 day chart, or you're looking at 2 days, 3 days chart. You just want to analyze certain thing. You want to study about that particular security for their trend for past 1-2 days or 1 or 2 weeks. So less than 3 weeks if you're studying the chart, then yes, it will be known as a minor trend. Okay, less than 3 weeks. Now, tool of technical analysis. Technical charts is the best tool. Now, I'll take you all through the charts. Then the theory part inside of this, you can just read it, okay? Because I cannot explain charts while reading it. So, we all know there are we have line charts, we have bar charts, we have candle and stick chart, point and figure chart, okay? So, let's study about the line chart. Now, line chart is what? This is your line chart. Okay, wherein your date C is given on the x-axis, your price is there here. Okay, this is your price, and with the help of the line point, you know that on 7th of November, if you see, it was really down. On 6th of March, if you see, it was on its peak. It had touched like what, 2400. Okay, so with the help of the peak, the point, you can analyze the price on that particular date or day. That is the line graph. Similarly, you have a bar chart. In the bar chart, there is one, in line chart, you will never come to know the open and closing price on that particular date. In bar chart, you will come to know that. In bar chart, because it is in the form of a bar, no? I'll show you a bar chart. So say this is in the form of bars. Can you all see this picture? Here, it is in a form of bar stick. Okay, so here basically you are able to have a opening, closing price, etc. offer. It is in a bar stick form. All these type of charts. See this. It is in the form of bar. okay, wherein you will be able to know that okay, the price had opened at this, it had closed at this value. So bar charts are more practical. It is better to see that. Okay, similarly with the bars, you can make a candle and stick chart. Now see, what is a candle and stick chart? This is a candle and stick pattern. Now in candle and stick pattern, what happens is, say it has opened here. If you see, one minute, just give me a minute. This one, okay, if you see, there is one open. Okay, so it is giving you the shape. Okay, it is giving you the shape of a candle. Why? Because it had opened at low. They have shown you the closing price also, and they have shown you that means opening and closing price is obviously there, and how much it has gone below the opening price and how much it has gone above the closing price is also there. So the daily low and the daily high price is also there. Opening and closing is also given, and there is a body here. Okay, so with this body I can understand that it has got a sustainable body. Okay, when it opened at low, it started rising. It has closed also at high only. Okay, though it went higher than that, it could not sustain that, but it has closed over here. Similarly, daily bearish candle, if you see, this was a bullish candle where the price is rising. In bearish candle, what happens? It had opened at really high price. Okay, opened here and then it closed at the low price. It also went higher than the open. It also went lower than the close. But this is a bearish candle. Now sometimes what happens, these candles are in form of a star. You will not be able to see only the body of the candle. Why? Because it is not able to sustain only that pattern. It had either shooted up after starting from low, okay, or it had either shooted down after starting from high. So there are candle and stick, there is a star also. Candle and stick star pattern. You will not be able to see the candle's body. Here it is. Okay. So when I see green, I know that it had started from low. It tried to go high. It went really high, but it could not sustain and it has come back to that. You can really not see that particular candle when I'm talking about a candle and stick, star. So here see, this is what they have given. Now if you will read this, you will understand. Okay, like a bar chart. It is like a bar chart only, candle and stick chart. They have a thin vertical line. These vertical lines which I showed you, they show the price range. Okay, for a given period, which is shaded in different colors. So if it is rising high, it is a bullish trend, it will be green. Bearish, it will be red. Okay, so the difference is a wider bar or rectangular that represents the difference between the opening and the closing price. Also it shows the highest price it went to and the lowest also price which it has gone to. That is your candle and stick bar. Okay, then patterns which are created by the charts. Now patterns means what? That if a particular stock price had started from here, from this point, it started rising, it reached a point from where again it started falling. It did not fall below this, again it started rising. Now if I see this particular trend, I know that though it is falling, but the lower lows, there are lower lows and higher highs. When it is rising more than this resistance point. Again, when it is rising, it is more than this resistance point. Here also it will fall, but it will be lower, no? The fall is not as much as this low. Here also the fall is not as much as this low. Okay, so patterns which are created are these support and resistance level. Then you have the shoulder, head and shoulder, which is known as head and shoulder level also. Now what does this mean? Now see this. Here the price was here, okay, of the stock. It started rising till here. Then it had a fall. So it is like a candle and stick chart only. Here it had a fall. After this again there was a little bit of rise. Again there is a fall. Okay, now if you see this particular chart, when the fall was there, again when it started rising, it touched this peak. Okay, there was a fall, it started rising, it touched this peak. This is known as the head. Again it started falling. And it again started rising, but it could not go and cross this peak. It did not cross the peak. So basically this peak has now become the head. It has not crossed this peak. It could reach the height only of this particular, when it had started falling from the left shoulder. So this is known as left shoulder, this is known as the right shoulder, the lower high. I know that if it is going to come on the same line here, which is known as the neckline, it is going to fall drastically. Okay, this is also analysis which is done. That if a stock has now gone beyond this neckline, it is going to really fall down. That is also known as a left shoulder and head and shoulders configuration, head and shoulders analysis. Okay, see, a formation similar to head and shoulder is created wherein the neckline acts as the resistance or the support line. So this is your support line, or you can even say it is the resistance line from where there is a reversal in the position. Okay, as the head and shoulder top is formed, the resistance level appears at the top of the head. There where is a resistance, and down this is the support. The volume starts declining near the head top and the reversal sets in. The volume becomes heavy again and shrink near the neckline where another reversal trend begins. Okay, so this is now a reversal trend. It started with going high and it is going to end with a reversal trend. So head and shoulders pattern is, this is what it is showing. Okay, there is a left shoulder. It fell, it again rised high and it could not rise high after that. So that becomes the right shoulder. When the moment it falls below this neckline, it says that now it will fall. It will fall only. It will have lower highs and higher lows. Okay. So when it touches this, they say this is the potential target price. You should start buying the stock here. Obviously, you will buy a stock in the market when the prices are low. Okay, so this is a potential buying price. An inverse head and shoulder stock pattern will be what? When the price was high. Okay, and it started falling. It again rised. Again it started falling. This became my left shoulder. When it fell down below that also, it became my head shoulder. My head. Then it again started rising. It fell. It could not fall below the head point. So therefore it is my right shoulder. And now it has crossed my neckline. So I know that now there is going to be a reversal trend, inverse trend, which is going to go up. So now there will be higher highs and lower lows. Okay. Then we have triangle or a coil formation. Triangle or a coil formation means what? There is a lot of, this is an aggressive market wherein the buyers and the sellers both are very aggressive, and because of which the pattern of this particular stock is in the form of a triangle. So what happens? This is the buy price. Okay, this is the buying line. and this is the sales. Okay, now the buyers started buying, price started shooting up, and they sold. Again, when the sale started happening, aggressive buyers and sellers. Then again it fell down. Here again there was a buy. Okay, then price started rising high. There was a sale point here. Okay, so if you see the selling price, the price at which the buyers are selling their stock is not changing. They are selling approximately at the same price. But now once you started selling, obviously the price will go down. Again there will be a buy here. But if you see, the buyers are ready to now buy the stock at a higher price, though the selling point is coming here only. So now they have started holding up on the stock. Now they are saying all the buyers are not selling it, very few buyers. And since this aggressive nature, buyers have now started buying it. They feel that okay, now since the people have started holding on the stock, the price is not going to fall below this. So now let's keep buying even if it is at a higher price. So again the buy has happened here. Okay, again the buy has taken place here. Now once it reaches here, obviously this could have sold, this could, once it is a sale, the prices would have fallen, but now nobody is selling it. So there is no sale happening here. It is a buy trend only continuing. A little bit of fall will come where certain buyers will sell it at this point. Again the potential trend is continuing to rise higher and higher. Okay, so this is your potential point wherein you can buy. Triangle or a coil formation. Okay, where there is aggressive buyers and aggressive sellers. Now double top formation and double bottom formation is what? Double top. Top means when the prices are going to rise, increase. It has started from low, it has rise to the peak, and now again falling back. There is a neckline. It is not falling below the neckline. Again there was another same peak, double top formation. Now again it is falling, and now after the neckline, the moment it cuts the neckline, there is a breakout of the price. It's gone really low. Okay. Now double top bottom formation means what? Bottom. Double top formation, double bottom formation. Double bottom means the price started from here. It was a high price. It started falling. It reached here, the support level. This is the resistance level. On top it is resistance, ceiling. This is the ground. Okay. So it is the support level. It has touched the support level, started rising again. It touched the neckline, again it has started falling. Now once it has crossed the neckline, it is a breakout point. There will be a shoot up in the price again. Okay, so double bottom and double top formation. Simple. Okay, however there are certain limitations because if I tell you today to just open the line charts and see all the charts which are there for a stock, you will not be able to understand. It will not give you a buying selling recommendation also just looking at the charts. So only the specialists and technicalists who are really understanding these charts will be able to take a informed decision, or a decision which says that it will be advantageous. Okay. Technical indicators. Now there are risk and its types. We all know about this. We have studied this even in the earlier chapters. There are two types of risk. So when I am analyzing a security, obviously I am analyzing the risk. One is your systematic risk, which is not under your control. It is under nobody's control. It is macro in nature. It is the beta. And unsystematic risk is those which can be controlled by the company. Their prices or their purchase of the stock is not happening because of certain faults in the company. They are having strike, or they are not able to provide the demand, etc. Whatever it is. Okay, so there can be risks which are associated to the whole economy, which is there. It is macro in nature, which is your beta, which we apply, and there is an unsystematic risk which can be controlled by the organization. It is very micro in nature. systematic, unsystematic risk. Now in systematic we have types. Why? Because systematic risk is by the economy. So in economy, what changes is first thing interest rate risk. We really don't know. It is not in our hands. It is all based by it is all decided by the government. Okay, so whatever will be the interest rate, it may go high, it may go low. I have taken a loan on fluctuating interest rate, and my rate is going on increasing only. Okay, from 9.5 it has gone to 10, and now it has reached 10.5. So that is something which is uncontrollable. Market risk. However, the company is good, however the trends are good, nobody is buying. COVID example. Market risk. So whoever must have invested a lot of money, in case it must be a very bad position for them. Okay. And purchasing power or inflationary risk, wherein you do not have that much of power only to purchase. A lot of inflation in the market. Okay, so these are the systematic risks which are there. 1, 2 and 3, you can just read it. Important. If we have financial risk or credit risk, financial risk or credit risk is obviously your capital structure, your credit, your policy, your entire financials, how they are. That also there is one risk. So risk, systematic and unsystematic, we have these two, business risk and financial risk, which are under the control of the company. They can be corrected and they can be removed. Okay. Now approaches which we are already studying, fundamental, technical, and there is one last approach, efficient market advocates. Okay. Fundamental, technical we have done. Again it is repeated. Efficient capital market theory. Now what is efficient capital market? It is known as efficient capital market hypothesis. Now what they say is that the securities markets are perfect. This theory says that your securities markets are perfect, or at least not too imperfect. They are not too imperfect, or you can even say that they are in fact perfect. The theory states that it is impossible to beat the market because stock market efficiency causes existing share prices to always incorporate and reflect all the relevant information. So basically this theory is saying that all that what we did, fundamentals and technicals is of no use. Markets are always perfect for the investors who are disciplined. So whatever relevant information is available, the prices obviously adjusted and cooperated. So stock prices, share prices are always adjusted and they reflect the relevant information which is publicly available about that particular price. Okay. It is based on the assumption that efficient capital market prices of the traded securities are always fully reflect the publicly available information concerning that particular securities. Okay, so in this hypothesis that it is not possible for an investor to outperform the market because all the available information are built in the stock market itself. And this information is obviously free of cost. There is no transaction cost involved. All investors similarly view the implications, means every investor will imply the same meaning when they will study the stock. If they know how to study the stock, if today I am studying and I am already monitoring a behavior of a stock, everybody is going to monitor in the same manner. Okay, so they are saying that basically stock prices behave randomly under the above conditions. These conditions have been rendered unrealistic in the light and actual experience because there is not only transaction cost involved, but traders have their own information base also. Some information which I may have, you may not have. So in the second paragraph they are saying that this particular theory or this hypothesis is unrealistic in nature. It will show a random movement and it requires, these all assumptions are random assumptions. Okay. So hypothesis, this particular efficient market hypothesis is put a challenge by the fundamental and technical analysis to extend that random walk model is a valid description of reality and work of the chartist is of no real significance in the stock price. So they are saying this charts and all have no fixed significance, and this particular theory, efficient market theory, are of three types. They are saying there is a strong form, semi-strong form and weak form theory. Now what is that? Strong form theory, strong form efficiency. Now basically the information which is there available inside a company about their stocks and outside, insiders and outsiders. Okay, strong information available to both. Insiders also cannot do anything, there are a lot of regulations. Outsiders are not given that particular information, it's not yet leaked. So there is a strong form of efficiency. The market is going to stay perfect because nobody is doing anything about that information, right? So whether two sets of individuals are available, one having the inside information about the company and other are uninformed. The strong form holds that the price reflects all the information that is known. It contemplates that even the corporate officials cannot benefit because it is an insider trading thing, no? It is an inside information. So they are not going to benefit. They don't know about it. So it is a strong form of efficiency. Even if that particular information is available, nobody can do anything about it. Okay. So the market is not only efficient here, but it is also perfect. Okay. Semi-strong form efficiency. Here the price adjusts rapidly to all the public available information. So any kind of a publicly available information is there, price is able to adjust it, and that price is the proper price. It is the efficient and the perfect market. Whether good information, bad information, and that particular information is reflected in that particular price at itself. And then there is a weak form theory. This is the extension of a random walk theory. Okay, we will just read the random walk theory also. According to it, the current stock values fully reflect all the historical information, not the real time. Okay, so your stock value today, I am basically studying the past information, historical information. And if this form is assumed to be correct, then both fundamental and technical analysis will lose its relevance. Okay, study of historical consequence of prices can neither assist the investment analyst or investors to abnormally enhance their investment return nor improve their ability to select the stock. If you will just see the historical information, you will not be able to select the stock in a right manner. Okay, knowledge of past patterns of the stock price does not aid the investor to make any better choice. So here the weak form of theory states that the stock price exhibit a random behavior. So if they are moving in upward or downward trend based on the historical information, then it is a random movement and it is a weak form of theory. Okay. And last is your capital asset pricing model. We have done this quite a few times. Okay, your expected return is nothing but your risk-free rate of return plus your market premium adjusted with your beta. Okay, and there was this random walk theory which I just missed it over here. Okay, in a fundamental analysis, factors such as your economic, industry, company are considered, and then the judgment, and then you take the decision whether you want to. Basically we all do that. Okay, when I do that, there is another approach which totally neglects this. Okay, totally neglects it. According to the theory, share price will rise and fall on the whims and fancies of manipulative individuals. There are still big fishes in the market, like how it was Harshad Mehta scam. People were just believing him. Okay, so this is a random walk. Even if that company was not existing, people were investing. So I really don't know about that, but whims and fancies of manipulative individuals is always there. There are big fishes which are there in the market who are still controlling, and because of this there is a random walk which is happening. And these technical charts, if you're seeing and you're seeing the fundamentals, is not going to help you select the best stock. Okay, so this is it with your lesson security analysis. Okay, this is all the important topics and I have covered everything. Importance are the, all your charts, your line charts, your fundamental analysis, Dow Jones theory. This is what is mostly asked from this particular chapter, and obviously the practicals we have already solved. Okay, Fine. Thank you so much. Bye bye.